Bridgewater founder Ray Dalio sounding the alarm on the economy recently, arguing that the recent tariff drama is merely a symptom of deeper structural problems. Dalio said the global economic order is breaking down due to unsustainable debt and deep imbalances between debtor nations like the US and creditor nations like China. As these imbalances unwind, Dalio warned the current monetary order will be forced to change in a big, disruptive way, with major consequences for capital markets and the broader economy. Joining me today to talk about this and so much more, Michael Gentile. He's the co-founder of Bastion Asset Management and one of the most prominent voices in the junior and mining sector. And excited to see him in person in Montreal. We're going to talk about that. But Michael, welcome to the show. So good to see you again.
See you, Daniela.
Yeah, like I said, I'm excited to see you in person, and we'll give more information. But we are doing a webinar panel together on building generational wealth, and we'll have a link in the description if anyone wants to come and join us in person in Montreal this Thursday. Michael, talk to me about your thoughts. I know you've read Ray Dalio's books and you've seen his latest warning regarding this debt trajectory we're on that he says is just frankly unsustainable. And of course, with the passing of the big, bold, beautiful bill, we see how much more debt will be created. What kind of track are we on here?
Yeah, I've been very much aligned with Ray Dalio's views. I mean, I started investing in gold in 2015, Danielle, in a meaningful way. I went all in with my personal capital between 2018 and 2020, mainly because of that the fiscal unsustainability, the debt trajectory the U.S. was on, I felt even before COVID, was on an unsustainable path. And since then, we've had COVID, which, as we all know, took massive increases to the debt. We've had the Russia-Ukraine war, which I could talk about in a little bit. I think that's accelerated that issue. And now the tariff war. So there's been a series of events that have kind of thrown fuel on this debt binge fire. And I think the rubber is really hitting the road right now in terms of the U.S. Realizing, or the markets realizing, that the U.S. is on a completely unsustainable path. And I think, to me, Daniela, the biggest red flag I've seen in a long time was when the market corrected, 15, 20%. The S&P was down hard. The NASDAQ was down a month ago or so, and bond yields are blowing up to the upside. I have not seen that environment where you have the market in a crash mode, yields are going up and US dollars going down. That's a highly unusual cocktail of events. Typically, when the stock market goes down, the US dollar goes up and bonds go up, and therefore yields go down because it's a flight to safety. Seeing those three trade out of sync, to me, it's probably the biggest red flag I've seen the last 8 years in terms of the market sending a message that not all is well in the US bond market, and not all is well with the fiscal sustainability of the United States. And like I said, there's a few reasons, geopolitical reasons that are creeping in as well, on top of the financial reasons. We get to that. But there's a confluence of factors now that I have not seen this intensely ever in my career. And I think it's something people are very careful and very, very much pay attention to.
Wow. I mean, what do you think it's a scenario where the wheels completely come off, Michael, or is it repairable?
So what we have is, in the US, they're running $2 trillion deficits a year, kind of round numbers right now, $1.5 to $2 trillion. Kind of, if you annualize the interest expense and real borrowing costs today, you have $38 trillion of debt. And, the Russia-Ukraine war, they froze the Russian currency reserves, 300 billion of currency reserves. That sent a message to all countries that ever had disagreements in the United States that if we get into a major war or major geopolitical battle somewhere, that your US currency reserves are no longer safe or sacred. So what you saw, that many countries that were holders of US debt for many, many years have been massively unwinding their holdings. China selling, the Russians are selling, I think the Middle Eastern countries are selling. So that's adding more supply to the bond market at a time where the US is borrowing record amounts because of the massive deficits they're running. Then you slap tariffs on pretty much every developed country in the world, causing them to think about diversifying their trade partners, diversifying their opinion about the United States as a reserve currency. So you have massive borrowing at the same time where countries that typically would fund your deficits are now either selling your bonds or strongly reconsidering buying them in the future. That creates rising pressures on yields. And when you have a massive amount of debt, what rising yields do, Daniela, is increase your interest costs. So it further exacerbates the problem. So I think we're very close to having yield curve control come back again. There really isn't any other option for the US. And lo and behold, I saw an email this morning in my inbox saying that, the Treasury quietly bought about, I think it was $48 billion of bonds,
Right,
30-year bonds last week.
right.
They're not calling it yield curve control or quantitative easing, but if you're intervening in the bond market to buy bonds, that's exactly what it is. And so if you've got more deficits, more debt, and less buyers for your debt, the only natural buyer will be the Fed, or you're going to have
Exactly.
a massive pressure on your fiscal situation in the U.S. So that's what we're living right now. I think that's why gold is trading so well. The diversification away from U.S. dollars by central bank, but also another canary in the coal mine, so to speak, saying, look out here, the U.S. dollar and the deficit situation is completely unsustainable. And more people other than myself and Ray Dalio have been screaming about it for 10 years are now waking up to it because they're seeing
Yes.
it on the Bloomberg screens. They're seeing it in their trading patterns of things they don't
Yes.
usually see. So it's starting to wake people up to take a harder look at what's going on.
That's such a good point. And I mean, and to your, you mentioning that the Fed, would likely become the buyer of last resort. We've also heard how they would have to restart the printing press majorly to
Yep.
get out of this mess. I mean, I've interviewed people who have brought up numbers as high as 10 trillion to get us out of this mess.
Well,
Does that
mhm.
sound like an absurd number to you, or does that make sense?
Not if you're running $2 trillion deficit a year, Daniela. And also, another scary fact, Lavi Costa does some great work as well, put out a
Yeah.
chart the other day saying the deficit to GDP right now is about 6%. So your deficits can go
Right.
up as long as your GDP is growing, but deficit to GDP is about 6% right now. But in an average recession, your deficit to GDP increases by another 6%. That gets you to 12% of your deficit as total GDP. The only times we've seen that in the history of our country would be COVID and the COVID and the financial crisis, 2008. So those were times where basically the economy was at frozen standstill. So basically a run-of-the-mill recession would get you running deficits as high as we had during COVID and the global financial crisis. That just shows you how precarious a situation we're in and how much money is going to be required to restart the economy. We're running these deficits, Daniela, in a time where the economy has not been in recession. The economy has been doing okay, not fantastic, but okay. So we add a recession to the mix, and lo and behold, tariffs could be one of the main reasons that could put us into recession. That only puts you in a more difficult position and a need to print even more money. So yeah, 10 trillion does not seem, that's like 5 years of deficits. It could be 2 or 3 years deficits in a recession. So it's pretty quick.
When you mentioned that people are waking up finally to notions that you've been speaking about for over 10 years, it also made me think of the term reset that we're now hearing in mainstream media. Before, you couldn't, use the word financial reset because you were a conspiracy theorist. Do you think it looks like there's no option but some sort of monetary reset here?
I think we've been resetting for the last several years. Like what does mass inflation do? Like ask the average lower middle class American or Canadian how they feel about life right now. They're hating it right now because their bills are through the roof and their revenues are flat. So we're basically resetting the value of the currency bit by bit. What's gold telling you? The value of the dollar is not worth what it used to be. So you can either reset slowly by running inflation, much hotter for years and years on end and impoverishing people that way. Or you can do a big bang reset where you say, okay, we're going to reset gold to 10,000 or we're going to reset the dollar, or we're going to devalue our currency. Either of those scenarios are painful. You do it slowly, you do it quickly. I think we're heading towards that. And the markets are giving a signal that they're starting to sniff that out or price that in. Whether we do a hard reset or just a gradual impoverishment of the individuals over multiple years really depend on how bad a recession we have and what geopolitical cards
Right.
fall in our laps.
I don't want to, go on a tangent here, but you made me think of something of how, life is so expensive in the US. But as you know, I spent half the time in Canada, Michael, in Montreal, and products, goods are even way more expensive there than in the US. For example, I was looking at getting my dad like a robo cleaner for the barbecue. It popped up on my Instagram, and I said, "Oh, let me just see the cost." In the US, I think it was like $150, but in Canada, it wasn't double the price. It was 3 times the price. Why are goods so much more expensive? And it's made in China, by the way. It's not like a made in US product. Why are things so much more expensive in Canada?
Well, I think in Canada, I mean, I live here full time, and the average Canadian's been suffering a lot more than Americans last year because in Canada, our GDP per capita, which is like the wealth creation divided by number of residents of our country, the last 9 years has been flat. So in the US, you've been growing your GDP per
Yeah.
capita. If inflation is going higher, but your wealth creation is going higher. In Canada, we've been flatlining for 9 years, which is atrocious. What that means is the average person has no less money they had 9 years ago, but everything costs more. So like you're looking for presents for your dad, It just puts so much pressure. So, the Trump administration talked about trying to grow out of this debt hole that they have, this big debt, $38 trillion of debt deficits. It's very, very hard to do when you have that much debt. But if you're not growing, that is really catastrophic for a country. So I think that's why in general, Canadians are feeling things are more expensive. They can't get
Yes.
by.
Yes.
That's a stagflationary environment, which is the worst kind of environment you could be in when there's no growth and inflation. That's what Canada's living through for 9 years. And that is a big danger for many developed countries in the world.
Didn't mean to go on that tangent, but I had to ask you that. Let's talk gold now. Trying to find its footing here, but I think it's a safe statement to say it's had a remarkable year. Your thoughts on the run up in gold and the moment that gold's having here, Michael?
Yeah, so it comes back to some of the things we were saying, Daniela. When you talk about people losing confidence in the US as a reserve currency, I think still about 65 to 70% of the world currency reserves are held in US dollars. And if you go back to the 1970s, gold was 70% of the world currency reserve. So the US dollar basically has supplanted gold over the last 67 years as the primary reserve currency of the central banks and the governments of the world. But all those things we're saying, right? The unsustainability of the US ability to repay their debts, the devaluation of the dollar, the geopolitical concerns about freezing foreign currency reserves, the tariff issues, that is causing over the last 5 to 10 years a subtle but very large rotation out of the US dollars, debt and currency reserves into physical gold. And the reserves have gone from about 6-7% in 2015 to about 15 to 20% today. But the long-term trend of rotating out of US dollar assets into gold, I think is a perma trend, multi-decade, multi-year trend. And you're going to see real physical buying. Gold has done a lot better than the financial models would have indicated, typically based on rates and negative interest real rates, because of the central bank buying. We have not seen central bank buying of gold of this magnitude for probably 40 to 50 years. So we're seeing a real shift in the way gold is priced, and gold is assuming its place as money again, which is really, really important when you talk about reset or talk about underpinning currencies in the future. So that's kind of episode one. And episode two is, you think when you see about financial investors going, all the uncertainty about tariffs, about interest rates, about the market, you're starting to see gold assert itself again as outperforming asset classes in times of uncertainty. We're entering into a period of, I think, more uncertainty, which is very positive for the typical financial buyers that would want to, start building positions in gold. So the tailwinds are been really positive for gold, but I think it's structural more than just a short-term trading. When gold go down $100, $100, of course it can. But structurally, we're seeing, I think, a multi-year, multi-decade rotation, and central banks don't care about price. They care about allocation and they care about long-term strategy. I think we're going to see a very consistent physical bid for gold for years ahead.
A multi-year bull run ahead.
Strong physical demand for gold like we haven't seen in decades. So that puts a lot less volatility in the gold price when you have physical buying. When in the past, it was a financial instrument, right? JP Morgan would trade it, hedge funds would trade it. Now we're seeing, central banks making asset allocation decisions, foreign currency reserve, multi-decade decisions on this. That's why you're seeing the gold price so firm. And every time it sells off, you're seeing pretty strong bids coming back in because their physical demand in the market is quite robust.
Well, to that point, I couldn't believe this. I had to look this up and fact check it. But the central bank stopped buying U.S. Treasuries as of 2014, and have bought $600 billion worth of gold. Actually, that figure's higher now because I looked at this about a month ago. $600 billion worth of gold.
Yeah. If you look at 2014, Daniela, there was 95% of treasuries were held by foreign governments. That's now down to about 75%. And gold was, I said, 6% of the reserves, now down to 15. So you have one chart rolling down, the other one rolling up, because you have, you're selling your bonds and you're buying gold. It's very, very clear when you see these charts what's happening. And like I said, when central banks make a decision to say, I want to have 20% or 25% of my foreign currency reserves in physical gold, they don't go, what's the price today? They're not a trader like I am or investor like I am going, should I buy it at 3,200 or 3,250 or 33? They're allocating, like I said, hundreds of billions of dollars on a systematic basis every year towards gold. And that's why you're seeing a strong physical demand in the market.
Well, which begs the question, Michael, what do they know? What do they know that is making them have that gold has this stranglehold almost on them? Like, here's this 6,000-year-old asset that central banks just want to hoard.
Mm-hmm.
Why?
What do they know? Well, they know coming right back to the beginning of review, they know that some type of reset's coming, and a reset in the value of the dollar and a reset in the value of hard assets versus paper money. It's because the U.S. needs, back to our point, the U.S. needs to print money, quantitative easing, what do you want to call it, intervening in the bond market, yield curve control. It's all the same thing. We're going to need to intervene in their bond market by printing more money to keep yields at a level that can allow the U.S. government to be solvent By doing that, you're massively devaluing the value of any hard asset. And gold is the only hard asset, true money, it's global, that cannot be printed. So that's why it's going to keep increasing on a relative basis. Gold's not going up; the dollar's going down, right? You're printing more dollars. That's what's happening. It's not. We're looking at the long lens. The S&P 500 will probably make new nominal all-time highs for many years as you devalue your currency. Look at Argentina. Argentina, their market made consecutive record highs for years and years, but they had 80% inflation. So you got to be careful when you look at nominal things.
I always say you just need to use the logic when you're thinking about investing in gold, and that point right there, it should be enough. The devaluation of the dollar via gold. Period. That should be
Mm-hmm.
enough motivation to want to own
Yep.
gold, in my opinion. Um, you mentioned central banks are not price sensitive, correct? But we all know, obviously, the retail investor is, and they're looking at these levels. A lot of people I speak to thinking, "Whoa, gold's expensive," and we can make the argument, well, it's expensive for now, perhaps, but 1 year from now, you're going to wish you had, bought gold. Um, are you seeing that the retail investor is still on the sidelines here? We haven't seen the retail investor, Costco buying aside, really show up here for
We,
gold.
we definitely haven't seen the financial retail investors show up yet for gold. And that's showing up in the stock prices of junior miners and producing assets. So it hasn't gone mainstream yet, Daniela. That's your question you're asking. I
Yes.
hear more and more investors asking me about it. How can I buy gold? How can I buy silver? But you're definitely not seeing it in the financial markets. So, and the good proxy for me, Daniela, is silver. When you see silver start to really move, then you typically see the junior resource stocks and a sub $100 million market cap. So when you see those stocks starting to really move and perform really well, that's when it's probably gone more mainstream. So right now, I think it's central banks, really large hedge funds like Bridgewater and Ray Dalio's of the world that are starting to try to get ahead of the curve. But in general, no. Given gold's making new all-time highs, the interest level and the excitement in the retail space is still quite low. That's more fuel for the fire. I think that's more on the stock side and the financial market side. But I think the central bank trend is a permanent one, and then the retail will slowly gravitate towards us. I think having the markets be a little more choppy as well, like NASDAQ and the S&P being a little less easy to make money this year than it's been the previous year, also attracts some more interest. See what other corners of the market that are working. So I'm starting to pick up that as well, that gold's outperforming the markets this year. It's up, the gold stocks are outperforming the S&P 500, the NASDAQ. That creates a virtuous cycle of, hey, what should I look? What's going on in that corner? Why are people making money over there? That'll create more of a rotation over time. But that retail and the mainstream always follows later after a couple of years of really strong performance. So we have that also, I think, in our back pocket as future buying coming in the markets over time.
Yeah, just another point. Obviously, like I mentioned, you're one of the most prominent voices in the mining sector here. You alluded to that a bit, the discrepancy between obviously the gold price and the miners. I believe you're optimistic that spread will tighten here.
Mm-hmm. Absolutely. I think there was a big disappointment post-COVID, Daniela. You remember the gold price went up from like $1,500 to $2,000 very quickly during COVID. All the gold stocks did extremely well. Many union stocks went up 500, 600% in a very short period of time. And then what happened was the gold price went flat, and we had a massive inflationary period where the costs of the gold producers increased way faster while the gold price didn't do anything. So the margins got really juicy for like 6 months, and they got compressed as the cost went higher and higher. If you look today, Daniela, the gold at 3,300, the industry is earning by far and away the highest ever cash margins they've ever seen, both on an absolute basis and probably on a percentage basis. So the industry's never been more profitable. And I think what's going to happen is the longer these margins sustain themselves at these levels, the more and more money is going to flow into the sector. The Agnicos of the world, the Newmonts of the world, are generating massive amounts of free cash flow, buying back stock, paying dividends. Their bounties are pristine now. That'll attract a lot of generalist investors back into the space as they believe it's going to be more sustainable than it was during COVID. Because we're not in a hyperinflationary cost environment like we were during COVID, but the gold prices increase. So I feel these margins are much more sustainable and will result in a lot more interest in the sector going forward on a more sustained basis.
Michael Gentile, I look forward to seeing you in person this Thursday in
Yeah, it'd be a lot of
Montreal.
fun. We always talk online. It's so nice to be something face to face. But I encourage anybody who's in Montreal to come join us, come shake our hands, come get to know us. Human contact and face to face is a lost art these days. So we'd love to be in
Yep.
front of people in person and with you again, speak to you a little more fully in that interview.
Looking forward to it, Michael. And like I said, we'll have the link if anyone wants to register and join us in the description of the video. Thank you, Michael.
My pleasure. See you on Thursday.
See you on Thursday. I love the sound of that. And thank you all for watching. As always, I encourage you all to check out DannyReport.com. We obviously spoke a lot about gold investing. So if you're interested in getting started or silver investing, we have a ton of great reports, free reports, all on DannyReport.com. So go there, download what you need to get started. And we will see you all soon. That's it for me. Thanks for watching.